Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the wider moving average, a pivotal tool in technical analysis that can enhance your trading strategy. This moving average is renowned for its ability to adapt swiftly to market changes, offering you a sharper edge in identifying trends and potential reversals. So stick around until the end of this video to uncover how you can leverage the wider moving average for more precise entries and exits in your trade. So let's get started. We get started by understanding the wider moving average, and this wider moving average was developed by J. Willis Wilder Jr. is a unique tool that stands out in the world of technical analysis. Unlike the traditional moving average, it places more weight on recent price movement, making it particularly useful for short-term trading decisions. These characteristics allow you to respond more quickly to market changes, helping you identify trend and reversal with greater accuracy. The formula for wider moving average is designed to smoothen out price action or to smoothen out price data over a specified period, providing a clear picture of the market direction. And this is actually calculated by using the following formula, and this formula is the WSMA is equal to the summation of 1 minus WSAI plus the close. This formula ensures that the moving average is sensitive to recent price change while maintaining a stable trend line. Now let's see what this formula is all about. And this is the formula. The formula is this, as you can see on my screen. And this formula ensures that the moving average is sensitive to recent price change while maintaining a stable trend line. As you can see from the chart, the moving average, as you can see from the chart, the wider moving average provides a smooth line that closely follows price action. As we can see, this line closely follows the price action. Notice how it reacts to changes in price direction, offering clear signal for potential entries and exit points. By observing these interactions, you can make more informed trading decisions and improve your overall strategy. Now let's see how we can apply this strategy. We can apply this to our trading strategy. The wider moving average is a versatile tool that can be applied in various ways to improve your trading strategy. It helps you identify trends, generate signals, and even manage risks effectively. Let's explore a few practical options or a few practical applications of this powerful indicator. The first one is the signal generation. One of the most common use of the wider moving average is to generate a buy and sell signal. These signals are based on the relationship between the price and the moving average. For a bullish crossover, when the price crosses above the moving average, once price crosses above the moving average, it indicates a potential upward momentum. This is often seen as a signal to enter a long position. Excuse me. I was saying, like I said, this often is seen as a signal to enter a long position. When you see price crosses over the moving average line, this indicates that we should look for a long position. Now conversely, when we see the bearish crossover, meaning when we see price trading below the moving average, it actually suggests there is a possible trend to the downside, and this can be used as a signal to enter a short position. As we can see, once price went below this moving average, we could have short at this area and would have been in a in a very strong downtrend. Even if it was for a short time, we would have been in a downtrend, as seen in this example on the screen. Now we can also use this moving average for trend continuation. The wider moving average is also an excellent tool for confirming trends. When price consistently stay above the moving average, it indicates an uptrend. It says that when price consistently stays above the moving average, it means an uptrend, as we can see in this area. Conversely, if price remain below the moving average, you are likely in a downtrend. Using this as a guide can help you avoid trades in prevailing market direction. As you can see in this area, price was consistently below the moving average, meaning would have been in a selling trade or a downtrend. It is sure that yes, when you see price is below this moving average, this wider moving average, it means that we are in a downtrend. Here you can see how the moving average acts as a dynamic indicator of market direction. By aligning this trade with your trend, you can reduce risks and increase your chances of success. Now we can also use this moving average as dynamic support and resistance area. Another valuable application of the wider moving average is its role as a dynamic support and resistance level. In an uptrend, it often acts as a support, as we can see in the screen. It often acts as a support, while in a downtrend, it often serves as a resistance. Understanding this behavior allows you to refine your entries and exits while managing your risks more efficiently. By incorporating this application into your trading strategy, you can use the wider moving average to gain a deeper insight into the market behavior and make more confident market decisions. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like and subscribe. Always turn on your notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.